If you want to retire early and live off your dividend income, then you need to build a portfolio that does three things. Number one, pays you cash flow on a regular basis. Number two, increases that cash flow every single year. And number three, with those first two, your portfolio needs to offer an adequate amount of diversification. Now, you could check all of these boxes by investing in a wide selection of individual stocks, but if you want something more simple that doesn't require researching any companies and will probably deliver better results in the process, then SCHD, the Schwab US Dividend Equity ETF, and JEPI, the JP Morgan Equity Premium Income ETF, are the dividend dream team you need to get the job done. Now, investing in both of these ETFs can give you exposure to a wide selection of individual stocks, and for most investors, this can provide a better overall investing experience than researching and hand-picking individual companies. SCHD specifically contains a portfolio of stocks that focuses on the quality and sustainability of dividends. And to get more specific, they make it a requirement that all of the companies held within this ETF have to have been paying dividends for at least 10 consecutive years, so they require some sort of track record there. And there are a few metrics they look at to ensure the dividend is both attractive and sustainable. Cash flow to debt, which measures a company's ability to pay its debt, return on equity, which shows how efficient a company is at generating profits, and they look at the company's dividend yield and dividend growth rate, which for the ETF overall are two areas where it really shines. Here we can see that SCHD has a pretty nice 3.5% dividend yield with a red-hot double-digit 5-year growth rate on that dividend, which has been growing nonstop since the fund's inception 10 years ago. And many of the holdings within this ETF are household names you're probably pretty familiar with that pay a stable, consistent dividend like Verizon, Pepsi, Coca-Cola, Home Depot, and Pfizer, just to name a few. Now, JEPI, on the other hand, is a little different. This ETF also contains a variety of recognizable companies like the Hershey Company, MasterCard, Visa, and there's even some overlap with SCHD as they also have Pepsi and Coca-Cola, but this ETF employs a covered call strategy and writes call options on the S&P 500 to generate income, which they distribute every month. And that's the main goal with this ETF, is to generate consistent monthly income for shareholders. And if you didn't hear it from me, all you need to do is look at the overview on the JEPI website where it says the word income all over the place. Or you can just take a look at their dividend yield, which as you can see is much higher than SCHD's, currently sitting at about 12%, and these dividend payments have been growing since the fund's inception back in 2020. Now, individually, both of these ETFs have different things to offer investors, and when combined into one portfolio, their individual strengths complement each other perfectly and come together to form what I think is the dividend dream team. When combined, you can benefit from JEPI's extremely high dividend, which they pay on a monthly basis. You get that consistent and aggressive dividend growth from SCHD, and you get a broad level of diversification from both of these funds. In addition to all of those things, you also get market-beating performance. If we look at the total return of both of these funds, we can see that in the last year, they've both outperformed the S&P 500 by quite a bit. Zooming out across the last 3 years, we can see the same is true. While SCHD is up nearly 60% and JEPI is up nearly 40%, the S&P 500 is up about 30.5%. And if we zoom out even farther across the last 10 years, which in this example will exclude JEPI because they only came onto the market back in 2020, so they haven't really been around that long, but SCHD is still crushing the S&P 500 in the last 10 years by looks like about 70% almost. And what these charts show us is that with both of these funds, not only do you get a better total return than the overall market when times are good and stock prices are going up, but you also lose less money and see less of a drawdown when stock prices are taking a hit. And you might hear that and say, well, wait a second, Ryan, JEPI looks like it's actually down 10% in the last year. So how can you say it beat the S&P 500? Well, that's a great observation, and you're right. It is down 10% in the last year in terms of share price, which actually brings up a good point. This 10% loss you see is only the share price return, and it doesn't take dividends into account, which is an important thing to do, especially with JEPI, whose primary goal, you'll remember, is to generate income. And this is why when comparing different investments, it's important to look at total return, which takes into account both movements in share price and dividend income. When it comes to JEPI, a lot of people don't want to invest in it because most of its returns do not come from share price appreciation, which is a matter of preference. But for those of us whose goal is to sustain our lifestyle with this dividend income, then heck yeah, the more dividends, the better. And that's the good thing about investing in both JEPI and SCHD, because although JEPI doesn't do much in terms of share price appreciation, SCHD does. In the last 5 years, it's up almost 50% in share price. So with these two, you really get the best of both worlds, and overall, you get a high level of passive income that should grow every single year basically on autopilot. But like all good things that frankly do sound too good to be true, there is a catch, but it's not as bad as you think, I promise. Because SCHD and JEPI are ETFs, they have an expense ratio, which is basically the fee we investors have to pay to cover the costs of running the fund. Luckily, SCHD's expense ratio is as low as it gets, coming in at 0.06%, which means that for every $10,000 you have invested in SCHD, you'd only have to pay $6 per year in expenses. JEPI's is a bit higher though, at 0.35%, which means that you'd have to pay $35 in expenses for every $10,000 invested. But this is still much more affordable compared to other popular covered call ETFs like QYLD and XYLD, who both have expense ratios nearly twice as high as JEPI, so it's really not too bad. But guys, when it comes to investing in these two ETFs, two questions still remain. Number one, how much would you need to have invested in both of these to essentially be able to retire early and stop working? And number two, how long would that take? And to figure this out, we're going to look at a few sample portfolios, both with just these two funds, but the allocation is going to be different in each one. The first one, we're going to start with an even split between SCHD and JEPI. In the second example, we'll look at a portfolio that's more heavily skewed towards JEPI. And in the third example, we'll do the opposite and look at a portfolio that's more heavily skewed towards SCHD. And here you can see the assumptions we'll use. We'll account for an initial $10,000 investment with $100 invested into this portfolio every single week. Now, looking at our first example where there's an even split between SCHD and JEPI, we can see that the overall dividend yield for this portfolio would be 7.65%. And based on the estimated 5-year dividend growth rates for these two, it comes out to 6.89%. But just to be a little bit more conservative, let's change the 5-year CAGR for SCHD down from about 14% to maybe about 10%, just to be a little more safe. Now, looking at the results, if we invested in this portfolio for 10 straight years, we'd end up with about $8,500 in dividend income by year 10. If we scroll down 10 more years, we can see that this income grows dramatically to about $35,000. And what's crazy, if we go down just 5 more years to year 25, this income basically doubles and leaves us with an annual dividend income of just over $66,000, which I think is a pretty comfortable number to retire on. And at the end of this 25th year, this portfolio would be valued at about $871,000. Now, on our next example here, this portfolio is going to be more heavily skewed towards JEPI. So we've got 70% in this fund, and then we've got 30% in SCHD. And this portfolio would be yielding about 9.3% with a 5-year CAGR that's a bit lower, 3.88%. Now, taking a look at the results, by the end of the 10th year, we'd be bringing in just over $10,000 of annual dividend income. Scrolling down a bit more, by the end of the 20th year, this number quadruples and we'd be bringing in over $40,000 of annual dividend income. And going down 5 more years, guys, by the end of the 25th year, we'd be bringing in nearly $75,000 of annual dividend income, which is a bit more than in the last example. And this portfolio would have a pretty similar value as what we saw in the last example, so it's not too different there. Now, taking a look at our last example, this has us at 70% SCHD and 30% JEPI in the portfolio. And in my opinion, these dividend stats look the best out of the three. We got a really high dividend yield, about 6%, and the 5-year CAGR is pretty nice too, 7%. So this is kind of the best of both worlds in my opinion. But now, guys, taking a look at the results, by the end of the 10th year, we'd only be bringing in about $6,800 of annual dividend income, which is a bit lower than what we saw with the portfolio that was more heavily weighted in JEPI. Continuing on down, by the end of the 20th year, we'd be bringing in just under $30,000. And going down a little bit more, guys, by the end of the 25th year, we'd be bringing in about $58,500 of annual dividend income. And this portfolio would be valued at just under $860,000, which is the lowest that we've seen out of the 3 examples. And for the record, to reach a point where you were bringing in the same amount of annual dividend income as in the second example that was more heavily weighted in JEPI, it would take you about 27 years to reach this point compared to 25 years in the last example. And so overall, no matter which way you slice it, it's still going to take a number of years to get to a point where you're able to live off of dividends, even if you're investing in SCHD and JEPI, this dividend dream team. But in the investing world, that's really not a long period of time at all, guys. If you start investing when you're 25, it's like you could probably retire before you're 50 years old. I think that's pretty great. And if your goal is to live off of your dividend income, it's going to be exponentially quicker to go this route than if you were to just invest in something like VU, the Vanguard S&P 500 ETF. Using the same setup as in the previous examples, if you were to just invest in VU, you would have a fraction of the dividend income after the 25th year, and your portfolio would be valued at much, much less, under $450,000. And if we scroll down, by the end of the 50th year, you'd still have a fraction of the dividend income than if you were to just invest in SCHD and JEPI. To be fair though, your portfolio balance would be pretty dang sweet. You'd have over $3 million, which you could then reinvest into higher yielding dividend stocks to get a better return. But still, by comparison, you'd be able to retire and live off your dividends way early with SCHD and JEPI than if you were to invest in VU. And with that said, this approach and dividend investing in general, it's definitely not a get-rich-quick way to invest. And if you want to do it right, if you want to build something worthwhile, there are no shortcuts. However, I guarantee that if you just start investing and you keep at it for 15, 20, 30 years down the road, you will be thanking yourself and you will be so glad that you got started. And I know it may seem like it's going to take a really long time to see results, but you will reach a point, and it will happen sooner than you think, I promise, where that dividend snowball really starts to take off. And that's what I'm telling you about in this next video right over here. I'm going to share with you where this point is, when it happened for me, and what it's going to take to reach this point in your own investing journey. So click right here to learn all about it, and I'll see you in the next one.